The IRS is about to tax your Social Security lump sum. You have 13 days to stop it. Congress passed a law to give you back the Social Security benefits you were owed, benefits that were taken from you for decades. 3.1 million retired teachers, firefighters, police officers, and public servants received lump sum checks in 2025, averaging $6,710 per person. $17 billion in total, money the government owed you, finally paid. And now the IRS wants a cut, not because you did anything wrong, not because you cheated the system, because of a timing rule that turns a decades-old correction into a single-year income spike. And that income spike is about to push millions of retirees into a tax bracket they have never been in, trigger taxation on Social Security benefits that were previously untaxed, and in some cases, increase your Medicare premiums for the next 12 months. The deadline to deal with this is April 15th. That is 13 days from today. And the IRS is not going to call you to explain what is happening. But I am. And by the end of this video, you will know exactly what to do. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. And let me take you back to where this started, because if you do not understand the history, you will not understand the trap. For over 40 years, two provisions in the Social Security system penalized public sector workers. The windfall elimination provision, known as WEP, and the government pension offset, known as GPO. If you worked a job that did not pay into Social Security, like teaching in certain states, or serving as a firefighter, or working for a federal agency under the old civil service retirement system, these provisions reduced or completely eliminated your Social Security benefits, even if you had paid into Social Security at other jobs for years, even if your spouse had earned full benefits that you should have been entitled to as a survivor. The math was brutal. Some retirees lost hundreds of dollars a month. Some lost their entire benefit. Widows of public servants who expected to receive survivor benefits got nothing. It affected over 3.2 million Americans. For decades, they fought to change it. On January 5th, 2025, Congress finally passed the Social Security Fairness Act. It eliminated WEP and GPO entirely, and it made the fix retroactive to January 2024. That meant every affected retiree was owed back payments for every month since January 2024, when their benefits should have been higher. The Social Security Administration moved fast. By July 2025, they had processed over 3.1 million payments totaling $17 billion. The average lump sum payment was approximately $6,710. Some people received more. Some received less. But for millions of retirees who had been shortchanged for years, it felt like justice. Here is where the trap closes. Under current IRS rules, Social Security benefits, including retroactive payments, are taxable in the year they are received, not the year they were earned, not spread out over the years they should have been paid, taxed in full in the single year the check arrived. That means if you received a $6,710 lump sum in 2025, the IRS treats that as $6,710 in additional Social Security income for tax year 2025. It hits your return right now, the one due April 15th. And for most retirees, that spike does not just add to your income, it triggers a cascade. And let me show you exactly how this plays out. I want to walk you through 4 real situations so you can see the math. Scenario 1, a retired teacher in Ohio. She is 68 years old. She receives $22,000 a year in Social Security and $18,000 from her state pension. Her provisional income, that is her adjusted gross income plus tax-exempt interest, plus half of her Social Security, was sitting at about $31,000. That put her in the 50% zone, meaning half of her Social Security was taxable, uncomfortable but manageable. Then the lump sum arrived, $7,200 in retroactive benefits. Half of that, $3,600, gets added to her provisional income. She jumps from $31,000 to $34,600. She just crossed the $34,000 threshold. Now up to 85% of her Social Security is taxable, not 50%, 85%. The difference in her tax bill is somewhere between $2,000 and $3,000 in additional federal taxes. On money Congress said she was owed. On money she probably already spent on medical bills and groceries. Nobody warned her. Scenario 2. A retired firefighter couple in California. Both spouses are former public safety workers. Both were affected by WEP. Combined lump sum, $14,000. They file jointly. The income spike does not just push more of their Social Security into the 85% taxable zone. It pushes their modified adjusted gross income above the IRMAA threshold. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge the government adds to your Medicare Part B and Part D premiums when your income exceeds certain levels. The surcharge is based on your tax return from 2 years prior. That $14,000 lump sum received in 2025 will affect their Medicare premiums in 2027. They could pay an extra $70 to $240 per month per person in Medicare surcharges for 12 straight months. Not because their actual financial situation changed, because of a one-time retroactive payment that inflated 1 year of income. They are being penalized for receiving money they were owed. Scenario 3. A 72-year-old widow. Her husband was a state employee. After he passed, she applied for survivor benefits. Under the old GPO rules, those benefits were eliminated entirely. She received nothing. The Social Security Fairness Act restored her survivor benefit and sent her a retroactive lump sum payment, but she files as single. The thresholds for single filers are lower: $25,000 for the 50% zone, $34,000 for the 85% zone. The lump sum pushed her over both thresholds in 1 year. She went from 0 Social Security taxation to 85% taxable in one filing. She is now grieving, navigating a new filing status as a single person, dealing with the widow's tax penalty that comes from losing the joint filing threshold, and sitting on a surprise tax bill that nobody at the Social Security office mentioned when they sent her the check. Scenario 4. A retired police officer who already filed. He did his return in February. Used a standard tax preparation service. He saw his refund was smaller than expected, paid his bill, and moved on. He did not know about the lump sum election. He did not know about the $6,000 senior bonus deduction. He left approximately $2,500 to $4,000 on the table. I am going to explain both of those in a moment because they are the two things that can fix this. But I want you to understand first what the common mistake is, because almost everyone is making it. The mistake is filing your 2025 return normally, seeing a higher tax bill than expected, assuming that is just how it works, paying it, and moving on. Without knowing that the tax code gives you a tool to recalculate that lump sum payment. Without knowing that, Congress quietly created a brand new deduction for seniors that most tax software is not applying automatically. If you received a lump sum payment under the Social Security Fairness Act, and you filed your taxes without using these two tools, you almost certainly overpaid, and you have 3 years to fix it. Let me start with the first tool. It is called the lump sum election. The IRS allows you to choose how you report a lump sum Social Security payment. You have two options. Option 1, you include the entire lump sum as income in the year you received it. That is the default. That is what happens if you or your tax preparer do nothing special. The full amount hits your 2025 return and inflates your provisional income. Option 2, you use the lump sum election. This lets you go back and recalculate the taxable portion of your Social Security benefits for the prior year, 2024, as if the retroactive benefits had been received when they should have been. You figure out how much of those benefits would have been taxable in the prior year, subtract that from the current year amount, and only report the difference on your 2025 return. The instructions are in IRS Publication 915. You compare the tax under both methods and use whichever produces the lower tax. You do not need to file an amended return for the prior year. The recalculation happens entirely on your 2025 return. For many retirees, especially those whose lump sum pushed them across a provisional income threshold, the lump sum election can save hundreds or even thousands of dollars. It is the difference between 50% of your benefits being taxable and 85%. Ask your tax preparer this exact question. Did you calculate the lump sum election for my Social Security Fairness Act payment? If they do not know what you're talking about, find someone who does. Now, the second tool. This one is brand new, and it is the reason I need every senior watching this to pay attention. The One Big Beautiful Bill, signed into law on July 4th, 2025, created a new deduction specifically for taxpayers age 65 and older. It is $6,000 per qualifying person. And if you are married filing jointly and both spouses are 65 or over, that is $12,000. This is separate from the existing senior additional standard deduction. This is on top of that. It did not exist before 2025. It was specifically designed to reduce the taxable portion of Social Security benefits for retirees. The income limits for the full deduction are $75,000 for single filers and $150,000 for married filing jointly. Above those limits, it phases out. Below them, full benefit. This deduction is available right now for your 2025 return. It is claimed on the new Schedule 1A. But here is what I need you to hear. Not all tax preparation software is flagging this deduction automatically. It is brand new. It was buried in an 1,100-page bill. Some programs have not been updated. Some tax preparers have not caught up. You might have to look for it yourself. Ask your preparer specifically. Did you apply the senior bonus deduction from the One Big Beautiful Bill? If they give you a blank stare, that is your answer. For a single filer in the 22% bracket, that $6,000 deduction saves $1,320. For a married couple, the $12,000 saves $2,640. Combined with the lump sum election, you could be looking at $3,000 to $4,000 in savings on money that is yours. Now, I know some of you have heard that Congress introduced a bill to fix this entirely. The No Tax on Restored Benefits Act was introduced in February 2026. It would create a one-time exclusion for the retroactive lump sum payments, meaning you would owe zero tax on the money. The bill has bipartisan support. It is in the House Ways and Means Committee. It has not passed. As of today, April 2nd, 2026, it is not law. Do not wait for it. Do not assume it will pass before your filing deadline. If it passes later, you can file an amended return and get the money back. But if you miss the April 15th deadline hoping Congress will save you, and they do not, you will owe penalties and interest on top of the tax you already owe. File now. File correctly. Amend later if the law changes. Here is your action checklist. 7 things you need to do right now. 1. Pull your SSA 1099. If you received a lump sum payment under the Social Security Fairness Act in 2025, the total amount is on your SSA 1099 form. If you do not have it, log into My Social Security at ssa.gov and download it. Note the total. That is the number driving your tax situation this year. 2. Calculate your provisional income. Add your adjusted gross income, your tax-exempt interest, and half of your total Social Security benefits, including the lump sum. If you are over $25,000 as a single filer or $32,000 married filing jointly, your benefits are being taxed. If you are over $34,000 single or $44,000 joint, up to 85% is taxable. 3. Run the lump sum election calculation. Open IRS publication 915. Follow the worksheet for the lump sum election. Compare method 1 and method 2. Use whichever produces the lower tax. This alone can save you $1,000 or more if the lump sum pushed you across the threshold. 4. Claim the $6,000 senior bonus deduction. If you are 65 or older with modified adjusted gross income under $75,000 single or $150,000 joint, you qualify. It goes on the new Schedule 1A. Make sure it is on your return. 5. If you already filed without these, file an amended return. Use Form 1040X. You have 3 years. Do not leave this money sitting with the IRS. 6. Check for IRMAA impact. If your 2025 income, including the lump sum, pushed your modified adjusted gross income above $106,000 single or $212,000 joint, you may face Medicare premium surcharges in 2027. You can appeal by filing a life-changing event form, SSA 44, with the Social Security Administration if you can show the income spike was a one-time event. This is not automatic. You have to request it. 7. Plan for next year. The Fairness Act did not just give you a lump sum. It permanently increased your monthly Social Security benefit. That higher monthly amount will affect your provisional income every year going forward. If you were near a threshold before, you may now be above it permanently. Talk to a tax advisor about Roth conversions, qualified charitable distributions, or adjusting your withholding to avoid a surprise next April. I want to be direct about something. The Social Security Fairness Act was the right law. Those benefits should never have been taken in the first place, but Congress passed the fix without addressing the tax consequences. The new lump sum payments would create income spikes. When they knew those spikes would push retirees into higher tax brackets, they introduced a bill to fix it. That bill is still sitting in committee while 3.1 million retirees file their taxes. The IRS will not call you. Your tax software might not catch it. Your preparer might not know about it. That is what this channel is for. If you know a retired teacher, a firefighter, a police officer, anyone who worked in public service and received a Social Security lump sum payment last year, send them this video. 13 days. That is what they have. And the difference between filing correctly and filing on autopilot could be $3,000 or more. Drop a comment. Did you receive a Fairness Act payment? Were you surprised by your tax bill this year? Tell me what happened. I read every single one, and the most common situations become future videos.